Hi, I'm Steve LaFrance with Blakely Financial, and here are some highlights from the previous month. Stocks and bonds continue their positive start in 23. Large caps are leading the way, with the S&P gaining 9.2% year-to-date compared to the Russell 2000's 0.8% gain, mainly due to big tech such as Microsoft, Google, and Apple, helping the NASDAQ 100 return 21.3%. Investment-grade corporates are up 5.3%, high yield at 3.9%, and inflation has dropped to 5%. Home sales are rising and oil prices are significantly below the peak from last June. The U.S. economy grew 1.1% in Q1, which is a slower pace than the previous 2 quarters and indicates the Fed's plan to raise interest rates is working. Their goal is to slow the economy enough to ease inflation without tipping into a recession. Striking the right balance is difficult, but a 1.1% growth rate could be a step in the right direction. However, consumer spending remains resilient even with the higher interest rates, which suggests the Fed's plan might not be working well enough, which explains why they voted unanimously to increase the rate by another 25 bips this week and then signaled that they may stop at this level for a while. For all the criticism, nobody can claim this to be a surprise, as Jay Powell has continually warned they are aggressively fighting inflation with a 5% interest rate target, and here we are. Hopefully at the back end of the fastest set of rate hikes in modern history, which has created a fair amount of stress in the system. Think Silicon Valley Bank, Signature Bank New York, and First Republic. The positive news is that goods prices have been coming down, and services, while still elevated, are beginning to trend down as well. As for the banks, we believe this is classic capitalism at work. It's actually okay for businesses that mismanage their risk to fail as long as customer deposits are not at risk, and so far, it's exactly what we have. The market recognizes this as regional banks who botched their responses to rising interest rates, exposing them to runs by their niche of wealthy clients, and we're not seeing this set up across the banking sector at large. The prevailing thought is the larger banks have done a better job handling the rising rates, and the damage should remain constrained. The next big headline concerning investors is the pending debt ceiling crisis. We'll share a dedicated article to get into the details, but the high-level summary is that a default will not be the end of the world, and the markets are treating it that way. This is because a potential default would be political and not economic, which is different than not being able to pay. In this case, we can and we will pay. It will just take some time to get through the political process. To put it in personal terms, it's the difference between being late on a mortgage versus foreclosing. No one is talking about the U.S. defaulting on its debt, and the market is reflecting that. Don't panic. This has happened before and will likely happen again. The headlines are making the most of the potential consequences, but there are enormous incentives to cut a deal before getting to default. And even if we get there, the expected market volatility will drive a deal at that time. Failure to solve this problem is not an option. So stick to your plan and do not hesitate to reach out to our team if you have any questions or concerns about your financial plan or situation.